for the last 2 years. So the last 2 years have been, you know, have seen a lot of unprecedented chain of events, starting with the pandemic in 2020, which took most of our attention and drove markets crazy. Early to mid 2021, we were infected by the second wave, and markets again went into sort of a dizzy then. By the time we recovered from that, we headed into a scenario where global central banks, led by the Fed, decided to, change their stance on monetary policy, unwind the massive amount of stimulus that was rolled out at the beginning of 2020, and spoke about the rate hikes for the first time. Little did we know when we started emerging out of the Omicron, spread that happened during December and early Jan, that we'll end up, with a Russia-Ukraine war and geopolitical sort of scare, which created a lot of volatility again in the market. There was a global risk-off, specifically over the last 2 weeks. It's only in the last few days that somewhat the markets have stabilized. I think if you were to look at market closing today, the Nifty and Sensex indices, both of them after a fairly long period of time have closed the week on a positive. While the markets will take cues now from here on in terms of what's the incremental news coming in from the Eastern European region, and also in terms of how markets start evaluating the way in which sanctions that are imposed by the Western economies on Russia really impact global supply chains, commodity prices. How long will these sort of sanctions impact the price, relationship, and the overall trade finance is something that needs to be seen. So we believe that we are entering into a
your screen is not moving. We are still
seeing. I'm not yet moving the screen, so don't worry. So, we believe that we are entering into a sort of a known, unknown sort of territory. And to our minds, it's necessary to keep a close watch on what's happening in the markets daily, and be very cautious when it comes to incrementally putting money into the markets. So with that background, and if you look at what we are saying from our March outlook perspective, we're trying to say that there's going to be a lot of volatility, and being cautious is necessary. A brief about how the previous month went by. So global markets fell across the globe, whether it's developed or emerging economies. Brent crude prices, while have settled around $113 to a barrel, had actually touched around $140 to a barrel earlier this week, late last week. The dollar index has been rising. People had across global markets started moving into safe haven sort of dollar assets. Gold prices moved up, had crossed $2,000 to an ounce. India was no different. Indian equities also were hit across the board. There was sell-off. The mid and small cap indices in particular took a larger hit. And amongst sectors, it was real estate, telecom, oil and gas that sort of delivered sharpest negative return in the previous month. Now, if you were to look at some of the key global macro points that one needs to keep a track of, apart from commodities, is how central banks are going to manage this entire dynamics between inflation and growth. So on one hand, commodity prices have shot through the roof. So just to give you some perspective, aluminum and nickel are at all-time highs. Crude itself has sort of reached or gone up by around 60-odd%. And the CPI numbers that are coming out of US, so the latest release came out at 7.9% on the headline inflation number in the US, and that's like a 40-year high. While a lot of economists were predicting that Feb numbers could be perhaps the peak for US CPI, but given the fact that we are going to experience a commodity price-led shock, and more like a supply side related impact on prices, more than the demand recovery related impact, there could be further higher numbers as far as the CPI data is concerned coming out of the West. So interestingly, and not too surprising to see that the European Central Bank actually went ahead and has announced the fastest stimulus withdrawal. So because it's clearly signaling that inflation is something that they need to control, which has far-reaching impacts on the overall impact on the overall demand as well as growth over the longer term, then the immediate impact that the current conflict or geopolitical uncertainty has thrown up. From a perspective of how many hikes does one expect? So markets were earlier expecting around 7 odd hikes from the Fed over the course of this year, but there's some sort of a moderation in expectations there. As of Feb end, this has been reduced to around 5 hikes that the market participants expect the Fed to do or undertake in this calendar year, because people want to give some benefit to the Fed officials, saying that they might want to moderate their stance given how the current situation impacts growth. One interesting point, Radhika, I hope you can see the slide. Anyways, so
yes, sir.
okay, thank you. So a small analysis that we've done, which tries to show how Fed tightening has really impacted markets, whether it's global markets or the Nifty. So on the left-hand side, you can see a table which shows across the last 20 odd years the various time frames in which Fed has gone ahead and increased rates in the system. So during, apart from the 93 to 95 scenario, where over the course of almost 2 odd years, Fed increased rates by around 3%, but the market or Indian markets on Nifty was kind of flattish. But if you look at all the other scenarios, while there could have been an immediate impact over the first 3-4 months or 6 months as far as Indian equities are concerned, but over the course of the entire Fed rate cycle, markets have actually reacted positively. And that's also the case when you were to look at the right-hand chart, which talks about how the Dow Jones, S&P 500, Nasdaq, or even the broader index, which is Russell 1000, has sort of reacted, to US rate hikes, right? So clearly, while this is one of the parameters that needs to be watched at, but this is not the only parameter which will determine, how equity markets sort of perform. So just a perspective that we wanted to give here. Coming to the hot topic, which is about commodities and how commodities sort of have been impacted because of this Russia-Ukraine crisis. So, to give you some numbers, Russia accounts for around 17% of global gas supplies and around 10% for the global crude supplies. If you were to look at it from a minerals perspective, so from a perspective of how much does it contribute towards aluminum, thermal coal, nickel, so that ranges anywhere between 12 to 20% of the total exports that happen for these minerals. So that's quite significant amount of capacity that comes out of Russia. While the current sanctions that have been imposed by the Western economies on Russia have been predominantly excluding energy and oil, while US has gone ahead and also sanctioned any Russian sort of oil and gas imports. But the point is that the contribution of Russian energy supplies to US is far relatively minuscule. It's the other minerals and commodities where the impact will be largely felt, and that's the space which is what is keeping everybody a little worried in terms of how the entire situation is going to pan out. Because while the sanctions have been imposed, it's the impact is twofold in terms of trying to find an alternative, which is not going to be so easy, and it'll take its own time to sort of substitute Russian supplies, and at the same time to even reverse the sanctions if they were to at some point in time. It's going to be a fairly long drawn process. So it's quite certain that in the near term we do expect commodity prices to remain elevated, right? So coming to Indian macro very quickly, if you look at some of the high frequency indicators, it suggests that our recovery has been fairly on track. Whether you look at non-food credit growth, power consumption, manufacturing PMI, which is more of a lead indicator and a high frequency indicator. Also, the core industries output has not really fallen substantially in the month of Jan because the impact of Omicron was fairly limited, compared to the previous waves. GST collections have been, quite strong. 5 months in a row, we're looking at 1.3 lakh crores plus sort of GST collections. From an overall growth trend, budget expectations of 8 to 8.5% GDP growth for next year. even this year, the budget sort of expected economic growth in India to come in at around 8.9 odd percent. Also, what has happened is, just to sort of recall, there's been a substantially high amount of capex that's been announced by the government in the budget, and that is a strong signal sort of to promote growth in a very structural sort of manner. That is a good point as far as Indian economy is concerned, because if we focus on investment avenues or funds or sectors which are less dependent on the external environment and more to do with the fact that there is so much capex happening or about to happen over the next couple of years, that should provide a fair amount of resilience to your investment portfolios, right? Another point that we wanted to highlight, so while a lot of people talk about crude at this level and what's going to happen next to inflation, current account, etc. Broadly speaking, try to put a comparative between where some of these key parameters were that you can see on the screen in September of 2014. That's the last time when crude was above $100 to a barrel, whereas where it is today at around $113. So you can see that current account currently is at around 1.6% of the GDP, somewhat comparable to what it was in 2014, but it's expected to sort of move up to around 2.5% to 3%, depending on various scenarios. To what extent does the government of India, pass on international crude price hikes into retail price hikes at fuel stations, gas pumps, etc. At the same time, how does crude in general behave over the next, say, couple of months? Whether it sustains at $100 plus, $100 plus sort of level, or does it sort of fall back again? Interestingly, the forex reserves are double the number than what they were way back in 2014. So from an import cover perspective, we are far more comfortably placed. Also, that gives a lot of room for the RBI to manage rupee volatility. So the RBI, we don't expect it to really control the levels of INR vis-a-vis USD, but it will definitely try and smoothen the impact of INR movement. So while we don't expect that the rupee will, we do expect that the rupee will depreciate, but maybe in a far more sustained manner. From a growth perspective, we are in a better space. So inflation numbers are already at 6% and could move higher. But again, like I said, it's subject to the way fuel price hikes do come in. Coming to so before getting into flows and valuations, a couple of more points on on CAD and inflation, because those are 2 points which I'm sure a lot of people have questions about. So according to a RBI study, for every $10 rise in crude prices, it sort of leads to 0.4 to 0.5% increase of current account deficit as a percentage of GDP. And similarly, when you were to look at it from an inflation perspective, a 10% hike in crude, leads to around 30 to 40 bips increase in the headline CPI number. So it's interesting to see whether we are going to see a 10 to 15% hike as far as crude prices are concerned, or is it actually going to be 25-30%, which essentially means that the government is passing on the entire hike in global crude prices to the retail pumps. So that's one interesting point. I mean, I was watching on CNBC earlier today, and the government is still sort of in a wait and watch mode, and not really wanting to take a drastic step is what looks like. From now coming to flows, if you were to look at the flows in this particular calendar year, we are already looking at 14 billion sort of net equity outflows in calendar year 2022 YTD. In fact, if you were to look at it from a perspective of month-on-month numbers, while Jan and Feb was around 5 billion odd negative, respectively, in the month of March, the first 9 days, we've already seen around 4.5 billion go out of Indian equity markets. What's interesting to see is that, as you can see from the chart, the top right corner, is that domestic institutions have been a steady counterbalance to FII outflows. And predominantly, a lot of that is coming via mutual funds. Also, from a SIP flow point of view, the bottom left chart on your screen, you can see that Jan numbers were at around 11,500. So Feb numbers came in at a shade under 11,500, but that's also a substantially higher SIP number if you were to look at the trend right through the last 1 odd year. Now, on the debt side, of course, Indian real rates don't look too attractive given where the inflation is. And from that perspective, we're not seeing too much movement either from FIIs, who are anyways very lightly positioned in the Indian debt market, and also from any sort of domestic investors. On any of the traditional valuation matrices, it's clearly can be seen that the excesses in valuation have sort of come off. We are trading closer to 1 standard deviation or slightly lower than that as far as forward P numbers are concerned. This number has further sort of dropped now, closer to the last 5 or 6 year average of around 18.5 times. Even from a price to book perspective, we are closer to three times 3/4 sort of a number. This number, sort of the market cap to GDP number, updates itself, or the data is available every month end. So as of Feb end, we are looking at a number which is at around 107 from market cap to GDP perspective. This number would have definitely fallen down further in the last few days. So what do we expect as far as Nifty earnings are concerned? Because we clearly believe that earnings will drive growth over the long term and decide the nature of returns that you will expect incrementally from your equity investments. So if you look at the top right chart, what we've tried to do is show you EPS growth year on year from FY04 and all the way up to our expectations for FY24, so the last 20-year data, and bucketed it into 3 different you can say time periods. So if you look at FY06 to FY12, earnings grew by around 13%. And if one were to look at the price chart or the returns chart for Nifty over that period, it would have sort of mirrored that number. Obviously, then 2008 happened, the great crisis, global financial crisis, and then multiple other issues. And you saw that earnings growth over the next 10 years, FY9 to 19, fell down to 4%. And Nifty returns were also closer to 6-7% annualized in that period. What we expect is, while a low base of FY20 is definitely one point, but barring that, if we were to look at it from a perspective of what we expect in FY23 and 24, from here on we don't see returns really panning out in double-digit sort of growth area. If you were to extrapolate it from FY19 to 24, we're expecting a 13% sort of growth. If you purely look at it from FY22 to 24, maybe we are looking at best case 9 to 10% sort of CAGR growth in earnings. And the primary reason for that being high crude prices. India, 85% of our oil demand is met via imports, right? So if oil prices do sustain at $100 plus levels and closer to 110 or 120 for a much longer period of time, it will result in higher inflation, eat into sectors which are highly dependent on oil and oil derivatives, as a raw material or inputs. It will not only impact our current account deficit, but because of the twin deficit nature that Indian economy has been sort of seeing for the last so many decades, in terms of fiscal as well as current account being in deficit, currency definitely could remain under pressure. That's one area which will make FIIs a little more circumspect about incrementally adding substantial money into Indian markets. Also, the bond yields will come under pressure. RBI for now has been maintaining a very cautious stance, but we expect that to change soon. So from that perspective, we think that macroeconomic stability could be something which one would be a little concerned about, at least over the next few months till the time crude doesn't stabilize. And that will somewhere also show into your overall earnings and flows. What we have done is, from purely an earnings perspective, and which is much against the consensus in the market today, we have lowered our expectations on earnings for FY23 and 24. So if you actually look at this slide, it makes it much easier, lesser numbers to really focus on. So the top right table, we're talking about FY24, which is March 24 Nifty earnings to come in at 900 rupees. The market is right now talking about closer to 1,000 rupees for Nifty in terms of EPS. So we've discounted that, given the risks that we were anyways running into as an economy and as markets as we headed into 2022. And on top of that, uncertainty that's been been brought to the fore as a result of the conflict between Russia and Ukraine. There's a lot more dependency now on incremental news coming from there. So we do believe that these risks will somewhere flow into the earnings projections. There are a lot of brokerage reports which have now already started coming, where there's been a little noise being made about the fact that certain segment in the market will perhaps see earnings downgrades. Some of the prominent auto players are already talking about how that could affect their segment. Similarly, maybe a certain set of chemical players, and the consumer segment in particular. So, basis that, we do believe that earnings rationalization is bound to happen. Like I mentioned earlier, we are trading somewhere closer to 18 and a half times if I were to discount FY24 earnings, current market levels. So as a base case, we do believe that markets by the end of this year could just remain where they are, or maybe a low single digit sort of return. But if some of the risks that we've highlighted, especially in terms of commodities, led by crude prices, if those were to stabilize or cool off, I think the markets then could really start re-rating upwards, or you could really expect some amount of earnings growth coming back. But having said that, even on the higher side, we don't expect Nifty to really breach the 17,800 sort of mark on the upside, purely from a December 22 number point of view. Given the current setup and our assumptions, and that means we're looking at a 9 to 10% sort of upside from where we are today at best. Also, one point that we wanted to highlight and to draw your attention to is that on a trailing basis we are at around 20 times, and in the previous events that have happened, whether it's 2011, the ECB crisis, 2013 taper tantrum, 2016 Chinese renminbi issue, etc. On a trailing P basis, markets have sort of corrected towards 14 and a half, 15 times on a trailing basis, right? So that's the range that we're talking about. So basis that you could test lower levels if the incremental news from what's happening on the geopolitical scenario worsens. We hope so it doesn't, but if that happens, maybe you could look at some sort of lower levels. So keeping that in mind, for investors who've got adequate exposure towards equities, it's prudent that you keep some powder dry and add on incrementally into markets through the year. So there's no real rush to go all out into equities if you are close to what your desired asset allocations are. The key is that you should know that for the next at least 2 or 3 quarters, volatility is here to stay. So for every dip in the market, you could maybe add a little bit of money or rebalance it out of your debt portfolios into equities, basis taxes, costs, etc. Where I'm sure your banker is going to really closely work with you. And but over the next 3 years or 4 years, equity should be able to deliver slightly better returns. Also, what's interesting to see is that from peak to trough, Nifty is down by around 12-13%, 12% maybe. But if you look at some of the stocks, they are down by upwards of 20-25%. So there is enough and more, space and opportunities available where people can invest into. So choosing the right set of managers who can identify businesses where there is clear earnings visibility, who have a very good, pricing power, especially given the fact that raw material prices are going up, and also, where the valuations are a little reasonable. So if these things sort of converge, and if and we can help you identify such managers, maybe those are the set of funds which you should be, looking at taking exposures to. For guys who've been sitting on sidelines or on cash and been wanting to wait for some sort of a massive correction, maybe investing over the next 6 odd months gradually for sort of better rupee cost averaging makes sense. Some of the risks that we've highlighted, we've already spoken about how inflation will, be a priority for central banks to address, and we could see larger sort of policy reversals or quicker. Elevated cost pressures eating into earnings growth, and a world after the current war, so higher commodity prices and oil prices, that's the key. So normalization of these is an essential. Coming quickly, I've spoken enough. I think the last 2 minutes I want to speak on is the fixed income piece. So Debt markets are less interesting these days compared to equities, thanks to what's been happening over the last 2-3 odd weeks. But if you clearly look at how the curve is looking like, look at the GSEC curve on the right-hand top chart, you'll see that it's fairly steep. If you look at the gray line, that's the current, the GSEC chart across 1 year to 10 year. And we find that on a risk-adjusted basis, anywhere between 4 to 6 years is the space to be in. Because after that, incrementally, you don't get rewarded for taking that additional duration risk. Similarly, this is the bottom right chart is a AAA chart, which is nothing but a mirror of what the GSEC chart is, just that you have a little more spread built in for the corporate. Having said that, on a real basis or real net basis, maybe GSEC AAAs don't really offer attractive returns. So that's where we believe that categorically adding to the high yield space or the credit space makes sense. From a credit perspective, I think we are well placed. If you look at any of the ratings reports or CRISIL reports, you'll see that there are far more upgrades in the market than the downgrades. So the ratio is far favorable. Also, we have not seen any accidents in the recent past of a nature which has caused ripples through the credit market. Credit is available at much lower rates because the RBI has still not gone ahead and started increasing its benchmark policy rates. Also, if you look at the bottom left table, you'll see that spreads of single A rated papers over a AAA is still at around 200-250 basis points. That's broadly across the spectrum. Similarly, for AA, it's upwards of 60 basis, and you can hardly see any spread in the single A space for moving from a GSEC to AAA. So it doesn't even sort of reward you for lower liquidity vis-a-vis govies. So what do we do on fixed income? We believe that there's again over here a lot of caution is warranted as far as rate is concerned, because we are in this entire period of transition of flux. So even the RBI is, I'm sure, trying to figure out what to say in the April policy, whether it is going to be the right time to really go out and say that, look, we maybe erred earlier. Our expectations of 4.5% on inflation for FY23 don't seem realistic now. We might have to revise them upwards. Also, the government in its budget has factored in oil at around $65 to $70 to a barrel, and now with $100 plus, a lot of their assumptions on borrowings, on current accounts, etc., I'm sure would undergo some sort of a revision. As it is, government bonds and corporate bonds were under pressure because of a very large borrowing program that the RBI had announced. The government had announced, and even there was no clear indication on the possibility of global index inclusion for Indian government bonds. So all of that has resulted in yields sort of moving up, and they have stayed there. So we do believe that long end of the curve is not somewhere where we'll be comfortable with, and staying in that 4 to 5 year, 6 year sort of segment, playing a mix of target maturity or roll down strategies makes immense sense. So these are nothing but sort of open-ended FMPs that we are playing into. The other piece is, like I mentioned, the high yield space or the credit space. Around 30-35% of your fixed income allocation can go into products which are well researched and curated, and not merely into credit risk funds, because a lot of credit risk funds themselves are playing a very conservative strategy. So, investment avenues like market-linked debentures or high-yielding bonds, whether they're coupon-bearing or on the market-linked side, can be looked at. There are also very interesting AIF options available these days in the market, in the venture debt space, on the real estate debt space, which can be selectively looked at. So that's broadly I wanted to cover on our strategy. Nitin, I'd like to hand it over to you now to take our viewers through your experience or a little more practical aspect to the world of investing. Thanks. You're on mute, Nitin.
Thanks, Saurabh. I just want to start by showing a graph which I think will put everyone's thoughts in the right frame that I would speak in. But where I want to start is that even though I'm heading InCred Wealth, I'm also an investor like you are. So I go through the same tensions and worries when the market goes down, and I get the same hunger or greed for making returns faster when the markets go up. And while Saurabh's presentation has been brilliant, I think looking back always helps you decide how to look forward. And therefore, I always like to show the past track record of the Sensex. I'm more comfortable on the Sensex because for a long period of time, that's been the main index. Now, this is from 2000 and is halfway through till about 2016. But if you see it, there have been 3 falls in the market in this period, and 10 to 20% falls are quite normal in that market. And sometimes it's fallen in an extreme situation. If I go to the next chart, also, which is a continuation from that, even it's fallen down 2 or 3 more times, but once it's fallen down sharply. So the way I look at the markets, irrespective of fundamentals, is this: the Indian economy so far has always grown, and it has always grown between 5% and 7%. And the thumb rule that I have been taught is that 3 times the GDP is what the market should grow at long term. So if it was growing at 5%, 15% average is fine. If it was growing at 7%, 21% return on the index is fine. Those are the thoughts that I carry. And it falls in between. 10 to 20% falls are normal. Twice it has fallen badly in the range of 30 to 60% in the last 20 years. But if you see both these graphs, in both those falls, it has recovered and resumed the growth path. Even here, this was COVID. It fell and resumed the growth path. Also, if you were to draw a line through the mean, you will see it's a gradual uptrend in line with the growth of the economy. So if you were to just draw a line on the center and you were to see where it would come, just by pure mathematics, it will come to some 45,000 or something. So markets, by and large, as long as economy grows, will grow on a gentle path, which will take it to its mean. And there will be periods where there will be bullishness. There will be periods when there will be bearishness. And I think, as Saurabh has pointed, we are entering a phase which will take it towards this mean, whatever it may be. Just one chart before I show I share my thoughts. If you see the peak of around 60,000, what returns were being given by small cap, mid cap, large cap. Long term, it was small cap was in the 18 to 25% range. Large cap was in the 13 to 20% range. 1 year was much higher. And in the current correction, it has fallen down sharply, down to large cap in the 5 to 7% range and small cap in the 18 to 32% range. So one way to look at it is there are opportunities. One way to look at it is market is going towards its long-term mean. Now, what should investors therefore do in such times? My guidance as a long-term investor is just be calm. And if possible, stop seeing the market on a daily basis, because events have their ways to play out. Economies continue to grow to their path. And it is well known and well stated that an event like a small level war will create 1 month of impact and 1 to 2 quarters of recovery. That's more or less the global view that has been taken on how these markets will recover. So you will have 1 month of extreme volatility, more driven due to the war, and then a 1 to 2 quarter of recovery, and then the path of the economy resumes. By nature, that takes you to middle of the year, which means that there is very limited time for the year to play out. As I say this, I think we should also recognize that event risks will now become part of the market, more because of the type of event that has happened, which gives confidence to countries to just take decisions in their hands. And investment strategies therefore have to factor in the fact that event risks may be normal in the next 10 years. And if there are periods where, like I told you, the average return should be 3 times the GDP growth or so, and if in a year you make abnormal returns, I think profit booking is important. Now, Saurabh has clearly covered the key parameters driving the market, but other than the Ukraine-Russia crisis, clearly inflation is playing an important role in what will happen globally post the war. post the ending of this crisis, and that is clearly showing higher interest rates globally. India may still take some time to catch up because we are following a different path slightly, and hence portfolio should be aligned for inflation shocks. Uh, Additionally, we must realize, if when we saw the chart that I showed you, that over the last 2 years, the markets ran ahead of their averages. And that happened because of excess liquidity and doleouts globally. So excess liquidity means money flowing into most markets, and of course, retail participation in India. So here on, clearly, Saurabh has said that return expectations have to come down, and long-term return expectations over the next 1 or 2 years should be in the range of 10%, one would say. Now, what does one do in such periods? Clearly, I think equity investments. So the primary strategy is to remain calm. If you have invested, I don't think anything will happen. You will get the levels back quite easily and markets will grow, but you'll have to give it time. Some reshuffling in portfolios is possible. Value stocks clearly are coming in. One can invest on corrections to take advantage of small opportunities which come, like when the markets were falling on the crisis. The banking Nifty or infrastructure stocks really crashed, and the corrections gave some opportunities. Structured product investing, where downsides are protected, are important because next 1 or 2 years there is risk to the downside. On the debt side, clearly, while the global path for interest rates is up, India may take a little more time for that path. So you have to look for good debt assets, even in the A-rated category, giving returns. Here, I would advise people not to be worried of the Templeton kind of fiasco, because even after Templeton happened, if you see it after the event, all the money has been returned. So taking good exposure to good assets in A-rated categories gives you returns. And clearly recognize that investment strategies now have to move from short term, which is 6 months. I mean, in the last 1 year or 2 years, we really felt every day is a short term. But now clearly we have to look into 2 time horizons, which I think are interesting. One is discounting to a possible NDA victory before the next general elections. I think you will get a strong rally there, and maybe a 2-year time frame to maybe April 2024 before the elections is a good period to look at. The other thing is the longer runway post the elections, in case we are not clear who will win, because the slope will continue irrespective of who wins. So then one takes in a 5-year or 4-year time frame post. So 2 time frames are important to figure out the next exits. One is 2 years later, and the other time frame is 4 years later. Depending upon needs, investments, one can figure out which is the time frame one should target, and one would make the good returns in that time frame. Short-term investors should clearly wait outside as things stabilize. Now, that is the broad overview that I would carry for markets which are traditional markets, where most of us invest in stocks, in mutual funds, in PMS strategies, or in debt products on a regular basis. But I also want to spend the next 5 minutes highlighting some changes that have happened, which I think everyone should recognize on how wealth creation will happen in India. And to that extent, I want to highlight the last phase of wealth creation in India over the last 10-15 years. And they happened in the public space, where listed stocks gave most of the returns and everything was on the table for investors to participate. What now appears to be happening is the private markets globally and in India are where the investors are making money, and then it is coming to the listed markets where the retail investors are taking it forward. To that extent, I think investing styles will evolve, and everybody should be cognizant of that. Now, let's see what will shape up. Markets are by and large investments into new sectors, new ideas which will give returns. And as you all know, what is driving up India is fintech revolution, maybe the electric vehicle revolution, maybe the clean energy revolution and the infrastructure revolution. So one is seeing a lot of investments which goes into these sectors, and it's clearly coming out that India will now go into being an innovation-led country. So it does look that over the next 10 years, you will see a number of innovation-led businesses coming up. And as a consequence of that, there will be a lot of innovation-led millionaires who will come up. And we've already seen it in the last 5-6 years, where there's been a new set of entrepreneurs and new set of employees making a lot of wealth creation. So what will happen in the next few years, therefore, is that conventional investment strategies will continue to work. I don't think they will go anywhere, but I think there will be wealth which will also get created differently. And if one is not careful, that wealth will overtake those who are following just conventional wealth strategies. It's already seen in, say, investors or employees of, say, DMart or Paytm or any of the new age chemical companies which have come up, where wealth has been created differently. So one should therefore look at what PE investors and family offices are doing with their money. And I think the broad strategies that they are following, and which Saurabh and us play a big part in advising, is one part is that the PE investors and the UUHNI families always book part of their money in their business once they see valuations are substantially high. And that trend has been seen in the last 3-4 months. And they protect a lot of the booked money by investing in good debt-based investing. So one part of the portfolio goes in good debt-based investing so that money made in the markets are protected. Then obviously a lot of people are exiting their businesses. They also want to invest in new businesses. So they protect their business interest by investing in new businesses which are futuristic in nature. And they look for profitability, because finally profitability is what guides the markets. And they're trying to ensure that the next wave of businesses, they participate by calculated risk taking. And we are seeing this both in equity and in debt. In equity, for example, we are seeing a lot of investments in consumer tech, in clean energy, in various themes which keep coming. And a lot of private equity funds and direct equity investments are coming up with unique deals and unique ideas. So I'm not marketing anything, but recently we did some ideas for a meat company which is moving from unorganized sector to organized sector. We did some investments for a cryptocurrency based software companies into education and learning globally. Clean energy, we are seeing deep tech is a sector which right now doesn't exist in India, but we're seeing opportunities globally. So clearly next generation ideas are coming up, and you get such opportunities either through private equity markets, and broadly the IRRs, which are the returns that the investors are targeting, are in the range of 30 to 40% per year in these ideas. That is how wealth gets created. Like I told you, conventional public markets will give returns of 3 times GDP, which will roughly be in the range of 15 to 18%. Additional wealth will possibly get created at those IRRs in the range of 30% plus kind of logic. And a lot of evaluations are done there. Same strategy we are seeing in debt, where conventional debt typically goes to instruments rated AA plus and above, returns of 5 to 6%. But people are going to products like MLDs, where they're seeing tax arbitrages, real estate kind of debt options, or credit types of options which see returns of 9 to 15% that come in. Parallelly, the international investing is also an area which is seeing increased interests from rich families and smart investors in India. I mean, it has to be understood that one of the trends that we are seeing in India is populism to win elections. That will possibly put strain on fiscal deficit going forward. Now, obviously, that weakens the country. So how to diversify that? Diversify globally. And just giving you examples, today I saw a product from a foreign player where a lot of Indians are investing through LRS, which is giving a return of 7% on dollar return in debt, safe debt, with rupee depreciation covered, which a lot of Indians are investing. We've seen ideas in global diversification through a portfolio of ETFs, which are now open. So the new investment trends definitely look for wealth creation through business linked opportunities for part of the portfolios, and therefore what I strongly say is, of course, conventional investments will have to continue. Conventional asset allocation tools, mutual funds being the backbone, direct equity being the backbone. But what can happen with that strategy is wealth expansion you may not participate in, and the smart or the PE investors or the UUHNI investors may definitely bridge the gap through aggressive investment strategies, or you'll see young people overtaking conventional rich through innovation and wealth expansion. And there have been articles which have said that what happened in China maybe 10 years back, which on expansion of new age investors becoming rich, may happen in the next 10 years in India, where a whole new set of investors will come up. And there, I think conventional investors need to participate. We are saying 20-25% of the portfolios need to get allocated. This is after you've taken care of your conventional investment strategies, not before. So first create wealth through conventional investment strategies and then diversify for the accelerated wealth. Now, as we go global, as investment practices become global, I think risk understanding is important. It has to be understood. And however, one should not get frightened of it. One should balance it by proper portfolio allocation. And that will come as you think like businessmen on the portfolio. And finally, concluding, I would like to say that earlier one would look at strategic portfolios as a strategy. Now I think for your long-term portfolio, strategic portfolio is needed. On that, you build small tactical portfolios, which are built when sharp falls happens. And I think finally, risk portfolio needs to be built in for accelerated wealth creation in case the next round of innovation succeeds. This could be for 20% of the portfolio, recognizing that your conventional strategic portfolio will give you most of your returns. Your tactical portfolios will give you the opportunities, and the risk portfolios will create accelerated wealth in case the bets work. If they don't work, your conventional portfolios will take care of the need. So therefore, summarizing, I think one doesn't need to panic on the conventional kind of investment strategies. There are tactical opportunities. Keep low return expectations, but these are the times to participate in risk portfolios long term. If you can get those opportunities either through banks, either through our advisors or independently with a long-term perspective, if India really delivers on its promise over the next 5 to 10 years. With that, I would hand it over back to Radhika to kind of take up queries or.
Thank you, Nitin. I think that was great. So if anybody has any questions, you could just type it in the Q&A box at the bottom. And I think we had a few questions coming in already. I think one of them is, where do you see the interest rates in India down the line 1 year from now?
Okay. Yeah. So, like I broadly covered when I spoke about the fixed income markets, I believe that over the next 1 year, clearly interest rates could go up anywhere between, purely from a policy perspective, by 50 to 75 basis points. That's been our view, which we'd also sort of rolled out in our annual outlook. So on a repo side, repo at 4 could easily go up to say 450 to 475. But having said that, the longer term yields, which is your 10-year, is currently at around 685 odd. That could be moving further up, given the fact that a lot of borrowings related dynamics will also be at play. So from that perspective, GSEC could move up higher to around say 7 quarter.
Can you just throw some light on corporate bonds, because that's where the spreads are good, right?
Sorry, I missed the earlier part of what you said.
Corporate bonds, that's where people can get good spreads, right?
Yeah, the AAA segment right now in the 3-year space is almost 5-10 basis higher than what your GSEC is at. So not too much of a spread there. But if you move further down the curve, we're looking at anywhere between 60-70 basis to around 200 basis points sort of spread. Clearly, this is one segment which, if other things remaining constant, will also move in tandem with what the entire curve moves. So by that logic, yields on the 3-year being closer toward, say, 8.5% in slightly better credits, and maybe closer to 10-11% on credits which are around the single A or the triple B plus sort of space, which is the true high yield space, is somewhere where you could really look at investing in actively.
So I just want to add on to this. Clearly, the path for interest rate movement is up, and one really can't predict where it will go. But the basic assumption is Indian economy will do well, and if Indian economy does well, the companies above investment grade, which is above A rated, will do well. Now one has to therefore wait for that phase when interest rates go up, and so it makes sense to invest in AA or A rated corporates, giving you a 9% to 8% kind of yield, and there are MLD products which reduce taxation sharply in the process, and then wait it out for an 18-month to 2-year time frame, and then when the interest rates go up to whatever level, you could then participate in the longer rate. So our strategies by and large are invest on the shorter end of the curves for the next 6 months, 1 year, and then as the rates stabilize, then you move to the longer term. So right now on debt investing, better to be in the shorter end than the longer end. Right, Saurabh?
That's right.
Thank you. The next question is, how should NRIs plan their investments from an international opportunities perspective and tax efficiency perspective?
Sitting in India, we are not really allowed to, recommend products or, give our view on products in the offshore space. So I will not be able to comment on that. It's just that, there are my limited point being there are multiple dollar denominated investments that are available both on the fixed income as well as equity side, and more so on the alternative space, some of which Nitin alluded to earlier during his talk. So a combination of, I think, ETFs, is a good play actually to be in, because it's cost effective from that perspective. But specifically, I would refrain from commenting.
So just to add there, domestic investments, we can give all our ideas. International, we have options, but if you could get in touch with Saurabh independently, through our Singapore and Dubai offices, we can give guidance on portfolios that you want to build on the international space quite easily.
Thank you, Nitin. The next question is, if oil stays at $150 to $170 for the next 4 years, inflation at 7 to 8%, GDP at 7%, interest rate at 8 to 9%, will automotive metals banks be valued at 6 to 8 times forward earnings? Very technical question, yeah. Sorry.
So I would like to address it in a couple of, a few points. If I were to break this question, firstly, expectations of oil being at 150 to 170, maybe we are not looking at that sort of a scenario to go by. This could have been a more relevant scenario if the current, ongoing tussle between the two nations really was to flare up. But there are indications that it might not go that way, and that's where oil has corrected from having briefly touched $140 to a barrel to being closer to around $110 now. If oil really touches 150 to 170, I think we're looking at much higher inflation, not even 7-8%. And the GDP will not come in at 7, it would be falling closer to, say, 5.5-6%. If I were to go by some of the assumptions and reports that I have read. So with that perspective and the interest rates clearly going higher, I think it could be that automotives or some of the other commodity related sectors could trade at much lower valuations. But to start off with, I don't think that's the scenario. We believe that oil could remain above 100 for some point in time, And while it will totally be dependent on incremental news, I believe that oil prices over the next, say, 6 odd months should sort of fall back, because there are multiple efforts being done for alternative reserves to be sort of released, and at the same time talks about oil production being ramped up to control the runaway prices. So given that, oil might not have an impact, but there could be definitely some sort of impact coming into automotives from a perspective that the supply chains on components gets impacted, and that is what would result in some sort of discounting. But maybe closer to 9 to 10 times is what I think one could expect these sectors to be at. Banks, of course, can't be valued on P on a price to book level. It could be closer towards, say, 2.5 times. I mean, a lot of top line banks like ICICI is trading closer to that number right now. So don't see too much of downside from here. Sorry, Nitin, you want to add something?
2-3 points. Firstly, everything in commodities is kind of linked to inflation. And one of the strategies, why is everybody talking of increasing interest rate environment? They want to slow down the economies. So if oil was to be above $150, I think you don't really need interest rate hikes of the level that one is talking of, because you will go into recession quite quickly, and that itself will cool down interest rates and the path. So this is a view that I heard just today, that if oil was high, then one of the tools to control interest rates is to slow down growth, right? And then that automatically gets in deflation, right? So in a way, then the cycles play out faster of growth, and markets will resume on its path. But for stocks like auto and essentially auto, I think the story is not around oil anymore. The story is their adaptation to electric technologies and how quickly they evolve that path. And I think the valuation of these companies will grow on how they evolve to the growth of their electric businesses or adapt to electric businesses, which itself is a different path. So valuations won't really get impacted long term through that.
Thank you. Thank you both. The next question is, every situation offers an opportunity. So is this the time to move your debt and corporate bonds fund to equity funds, universe funds, or vice versa to keep it in cash?
So, Sumit, it's important that you actually maintain asset allocation over a period of time. So just to give you statistics, I'm sure you've heard it enough number of times before that basis various studies, around 92% of your returns, are determined by asset allocation, not so much by security selection, and fairly minuscule by market timing, right? So from that perspective, if you have a particular end goal, you will have to follow and a certain amount of appetite to take volatility or risk. But there is a certain level of risk assets or equity assets and fixed income assets that you will maintain in your portfolio. So like Nitin mentioned, while long term is there, but tactically, of course, you could move your portfolio around by, say, around 5 to 10% by going underweight or overweight into equities, depending on what market offers. So if market is today being valued at, say, 18.5 times 1.5 year or 2 year forward earnings, right? It's fairly valued. It's not extremely attractive for you to really move out of debt and corporate bonds altogether and move into equities. If your debt allocations are really out of whack, or you're under allocated towards equities, you could start gradually deploying into equities at every possible fall or at lower levels. But to move out from one asset class to other is never really advised.
I just want to add on to that. I am a believer that one has to look for golden opportunities because the market is fully valued, say. And if one gets, I'm just putting a number, a 20% correction, then that is when you should put a lot of money into the markets, because that's when you get abnormal returns if you are in the short term. Otherwise, you don't know at these levels whether the markets are fully priced or not yet, because there are a lot of imponderables. So one kind of strategy is to look for sharp falls and then do lump sum kind of investing at those levels, recognizing that nothing can go wrong. On the other hand, would want to add that you should inflation proof your portfolios. So to that extent, you even if you look for equity funds, look for funds which are going on the value route, or for investments which are going on the value route, because those are typically more undervalued than conventional products that will grow. So manufacturing, which India will grow, or chemicals. I mean, you need to pick up value kind of infrastructure exposures. So such themes rather than conventional themes. But always my view is wait for the sharp fall. And of course, in asset rebalancing, part debt to part equity movement is fine. But always remember what debt you need to service your continuing requirements should not be touched.
One more question from the same client. Which kind of conservative fund is best to give good returns about of 10 to 12%, seeing the bond yield movements?
So, I look at it as two contrasting, sort of ideas or requirements in the same sentence. I mean, if you're looking at a conservative fund, you really can't be expecting it to be giving you, 10 to 12% returns without taking, commensurate amount of risk. So, like I mentioned earlier, some of the high yielding credits, which we've curated for our investors, with a 2-year, 3-year sort of horizon, we've been able to source that at around 10, 11 odd percent or 12%, right? But the ratings over there are sub single A. So if you're looking at a fund in particular, and if you're looking at, I'm assuming these are, gross returns you're talking about, you should, what we are looking at is really the high yielding credit space. So you can't really say that these are conservative in nature. Yes, you will not see them to be as volatile as equities are. So from that perspective, that they are definitely conservative. But from an inherent risk in the product, it's definitely going to be more risky, and that's where you're being offered a 10-12% sort of return. So we do offer, funds in the venture debt space, which will offer you around 13-14% returns. We do offer high yielding MLDs, whether it's lending card or
Saurabh, just talk of the Northern Arc.
Even the Northern Arc, yeah. So Northern Arc is another asset manager who we work with, and they offer you a combination of market-linked debentures, typically in the single A sort of space, which will offer you around 10% sort of gross returns. But that's the space you need to be. You will be taking some sort of a credit call there, not necessarily a volatile product, but definitely a credit product.
But it's a 2-year exposure kind of logic, so
2 to 2.5 years, yeah.
Not that risky, but definitely 10% and with a tax advantage.
True.
There was one more question of if there is any view on the LIC IPO.
So, Nitin, you could add there, while what I just want to say is that they've already filed and the DRHP has been approved by SEBI, but very highly unlikely that in such a volatile market you'll expect a 60,000 crore worth of IPO, make it to the markets. And as I read from the newspapers and other reports, it clearly looks like the government will want to wait and watch and the markets to stabilize before they come out with this IPO, because clearly they will want to see a heavy FI participation in this, which at this time where FIs are moving out money in tons looks a little difficult. So I don't see that coming in personally in this financial year. Nitin, if you want to add there.
Yeah, so conceptually, whenever the LIC IPO comes, the realization is it's one of the largest insurance companies in India. So to that extent, it will be a big IPO. However, the public float will be large and it will be one of the larger IPOs. So I would look at it more like a large cap kind of stock, which will give you steady returns long term. So let's wait for the IPO, but it's not a multi-bagger kind of investment, but will give steady returns over the long term. And one should ideally wait for price to be discovered before venturing into that product. But it really doesn't matter. One can always take small exposures and then build it up whenever it comes. But it'll be, if you want to compare LIC, you should compare the stock performance of SBI. That is the closest proxy in terms of any stock you had. SBI came with an IPO a long time back, has given you, and if you compare the returns of SBI and LIC, I think you will get some answers. So it won't be a private sector kind of leader, but it will be a steady kind of return giver.
Thank you. The one other question, I think the last question that we can take, what kind of funds do you prefer or suggest to invest in a range bound market?
Okay, so multiple options. Clearly, it can't be a one size fits all sort of a scenario, and we don't even believe in doing that. That's where we have a team of counselors and seasoned bankers who really would suggest products which are suitable for a particular investor. But broadly speaking, when markets are volatile, and if you really don't want to commit investments for a 1 year, 2 year sort of a period at this point in time, on the equity side, there are clearly for smaller investments that you would want to do balance advantage sort of funds, which we clearly offer. Now, those funds take benefit of the volatility and try and capture the spreads in the market and participate. Secondly, one can also look at arbitrage funds if one wants to take a 3 month, 6 month view to stay out of really committing into debt assets or equities and then move the assets because they give you a superior sort of post-tax return. Otherwise, there are also long short funds that are clearly available, which maintain market neutral sort of strategies, give you closer to 7-8%, 9% sort of absolute returns on an annualized basis, and that will help you to tide over the volatility. So broadly, this from an equity perspective. On the fixed income side, if I were to maybe relate volatility to interest rate risk, one can look at hold to maturity strategies, which essentially means that once you get into a strategy and hold it on till the maturity, any amount of volatility really doesn't impact your end returns at maturity. So could look at market linked debentures, which offer you fixed returns with a slightly higher tenor of greater than 12 months. You benefit from a superior taxation. At the same time, you can also look at some of the high yielding credits that we've been sort of speaking about through this interaction, which will help you to tide over the volatility.
I just want to add, Saurabh, slightly different answer, but it is said that best areas to invest in, at least on the equity side, is large cap funds, right? And if you want to replicate large cap funds with lower risk, you can invest in the index, which is an index fund on Nifty. But the worry is you want to protect capital. So why not invest in a product which protects your downside and gives you, say, participation of 115% on the upside of the Nifty, which is equal to the return or slightly better than the return of a large cap equity fund. That's where structured products come in, where the downside is protected and you get the upside participation of the Nifty with a 2-year time frame. So in addition to funds for ticket sizes of up to 20 lakhs, it is possible to invest in structured products, which will also give you of equity, which will also give you the returns of a large cap fund over a 2-year time frame. Saurabh, am I right in that?
That's correct, Nitin. I agree with you.
Thank you. Thank you so much. So I think, with that, we are at the end of the Q&A. Any closing remarks from you, Nitin, before we say have a great weekend?
I think people do not need to get worried. They need to continue their investment practices and take a long-term view into whatever they're doing, which is either 2 or 4 years, like I told you. And if India goes on the path of a lot of innovative companies coming up, then they should participate even in that wealth creation over the longer term as a thought process. Rest conventional investment strategies will work, nothing to worry too much. And we are always there to guide you all at every point of time on the views and
thank you. Thank you so much for your time, everybody. Thank you, Nitin. Thank you, Saurabh. Have a great weekend, all of you.